Hi guys, welcome back. In this video, we will solve a past paper question from May-June 2023, paper 21, which says, with the help of diagrams, explain the likely causes of depreciation of floating exchange rate and consider whether such a depreciation is always beneficial to an economy. It's an 8-mark question. So before I solve this question, there are two things I want to clear out first in the first go, and that is that first, see, this is a past paper solution video. It is not me explaining the entire concept, so I'm assuming that if you're watching this video right now, you're pretty much aware of the subject content. Secondly, remember that A-level examiners mark your answers based on how successfully you have fulfilled all your assessment objectives. Each assessment objective has separate marks, and I have already made 2 detailed videos on the marking pattern of the examiners and also a separate video on assessment objectives. And you can check both these videos out in the playlist All I Need to Know. It is assumed that you have already gone through those 2 videos in the playlist, and in case you haven't, then it is recommended you first watch those 2 videos and then come back on this videos. So guys, you'll start off your answer by a definition of the floating exchange rate, followed by a definition of currency depreciation, and then you'll move on to explaining the causes of depreciation. You also make the diagrams for depreciation of an exchange rate, and then we'll comment on, in fact, which would be part of your evaluation, the fact that the question asks you to consider whether such a depreciation is always beneficial to an economy, right? So the first is that, like I said, we'll start with the definition by saying, you could say that, a floating exchange rate basically is when the external value of a currency is determined purely by, and when I say purely, it means that this is what it is, right? It is determined purely by the supply and demand forces of the currency in the foreign exchange market without any sort of intervention by the central bank, right? And under this sort of a system, that is a free floating exchange rate system, the currency value fluctuates freely. It is allowed to freely fluctuate because the state bank is not going to, or the central bank is not going to intervene to manipulate the value of the currency. So the currency value fluctuates freely according to changes in the demand and supply of the currency in the foreign exchange markets, and those changes in the demand for and supply of the currency is driven by, or could be driven by, possibly factors like trade flows, that is because of the imports and exports, or investment flows, or the trade flows, or the investment flows, or by speculation, or other economic factors, right? So that's the definition of a floating exchange rate. So when you're talking about a floating exchange rate system, you're just saying that, maybe the demand for dollars could go up because of a rise in, exports of USA, which would increase the value of the dollar, the external value of the dollar. And let's say if investors lose confidence in let's say US economy, and they start selling off their dollars and they move their money out of USA, in that case the supply of dollars would increase, which will actually reduce the value of the dollar. Now basically what I'm trying to explain to you is that these changes in the value of the dollar, the external value of the dollar, are occurring without any regulatory attempts, or the attempt by central bank or by the U.S. economy, the central bank of the U.S. economy, which is known as the Federal Reserve, by the way. So without any regulatory attempts to control or stabilize the currency's value against other currencies, in a fixed exchange rate system, this basically happens. Then the next step would be that you define what a currency depreciation is. And you'll say that, a currency depreciation refers to a decrease in the value of one currency against the other currency in a floating exchange rate system, right? So basically, when the value of one currency is going down against the other currency, and what happens is that this phenomena actually means that when your currency depreciates, more units of the depreciating currency are needed now to purchase a single unit of the other currency, right? And what I mean by this is that, let's say, for instance, you could give an example by saying that, and it's good that you give the example, that, for example, you say that, let's say a dollar is worth 10 pounds initially. And now if a dollar goes down, the value of dollar falls to 5 pounds. So the value of dollar has gone down in terms of pounds, right? Which means that a dollar is now only worth 5 pounds. As in, the dollar can only buy 5 pounds, basically. So now what this means is that now a dollar can only end up buying 5 pounds. So dollar depreciates, dollar loses value against the pound, and dollar weakens. And like I said, depreciation means that more units of the depreciating currency here is a dollar, right? So more units of dollars are now needed, or more dollars are needed basically, to purchase a single unit of another currency, that is to purchase a single unit of pound. So let's say to purchase a single unit of the other currency. So let's say if people in the US want to buy something from UK that is worth, let's say, £10, right? And now they need to, initially they had to pay only $1 to buy that, but now in order to buy something that is worth £10 they need to actually pay $2 for it, right? So they need to pay $1 extra now, and that is what the depreciation is. That depreciation would mean that they need to pay more dollars now. So the depreciation is simply referring to the fall in the value of the currency against the other currency, that is pound, right? So for such questions, I would suggest that you take two currencies. A good thing is that you take. I usually tell my students to just take $1 and a pound and just keep the values simple, right? Now, once you've explained what a depreciation is, the next step would be that you tell why, in fact, what really happens when a currency depreciates. So the mistake a lot of students make is that they tell that the currency depreciates due to changes in demand and supply, while this is not the reason for depreciation. This is what is happening because in a depreciation, which sort of pulls the value of the currency down. But that's okay. But the real reason, what is causing the changes in demand and supply of the currency to actually pull the value of the currency down, that is what you need to tell in this question. So when a currency depreciates or it weakens itself, the supply of the currency, that is dollar, because in this case you've assumed the dollar, and you can, at the start of the question, you can select that what currency are you focusing on in the question, right? Whether you are the dollar or whether you are the pound, right? So when the currency weakens, the supply of the currency, that is the dollar, rises. So whenever the supply of a currency would go up in the foreign exchange market, the currency would depreciate, and or the demand for the currency could fall as well, right? So both of these reasons are basically during a depreciation, your supply is either basically going up, or your demand is going down, and your demand is going down. Both these factors could be occurring simultaneously, or either one of them. But primarily, the best way to show a currency depreciation is through showing or depicting an increase in supply of the currency, because that's the primary basis for the value of the currency to actually go down and the currency to depreciate. But primarily, we are concerned about what causes these changes in supply and demand. So if the supply is going, if you're showing that the currency depreciates due to a rise in supply of dollars, so what causes that supply to go up? And that is exactly what the question is asking as well. It says explain the likely causes of a depreciation, right? So that is exactly what you need to tell, what causes the supply to go up. Now the next step, guys, would be that you draw a diagram where you, and this diagram is very important because, so guys, see, diagrams in general are very, very important for your analysis and your evaluation. So when you're drawing diagrams, first of all, the diagram should be made very clear, as in you don't need to draw small diagrams. That doesn't mean that you need to draw huge, giant diagrams. But the size of a diagram should be such that it's clear and it's appealing, and just give the diagram some respect and label them properly. Draw them with a pencil and a scale, and make them neat. Also, when you draw a diagram, you need to write down. Ideally, it's the best would be that you also give a heading to the diagram, and also on the side, or down below your diagram, you just refer to what your diagram is actually trying to say. So for example, if I have drawn this diagram, then what ideally I would do is that I would probably use this space in my answer script to sort of explain what the diagram is saying in a few lines, or I could probably use this space in my answer to sort of explain what the diagram is saying. So I'll say that a diagram shows the depreciation of dollar, and what you will say is that so you label the axis. You don't need to say that the y-axis shows the price of dollar and all of that. You just need to say that the diagram shows that the supply of dollars shifts to the right, because it means that more dollars is being supplied and sold in the foreign exchange market to buy let's say pounds. and you'll say that your currency, dollar depreciates. You can assume a currency pound, and you'll say that in our example, our currency is dollar, so you'll say that a dollar depreciates against a pound, right? So you can now over here you can write P1, P2. You don't necessarily need to write the values. You just need to show the concept. Now on the y-axis you show the price of dollars in pounds, and this is showing the demand and supply of dollars, and it's showing how much dollars are being traded in the foreign exchange market. So the supply of dollars shifts outwards, and hence, dollar depreciates, the value of dollar against the pound goes down, and the quantity of dollars in the forex market being traded is rising, definitely, because obviously more dollars are being sold and supplied to sort of buy more pounds, and that ultimately causes the dollar to weaken and depreciate itself. So this is something that you need to explain. Like I said, you can use this space or you can use this space as well. Okay. Now, ideally, see, when the examiner would be checking your answer and he goes down, so the first impression would be that how clear the diagram is. The clearer the diagram, the more impressed the examiner is. And you see, if you write down the heading, so that even becomes much easier for the examiner to comprehend what you're actually trying to say. So if he's reading your explanation, let's say if you've written your explanation over here or somewhere down below, so he knows what the explanation would be. So he knows that, okay, fine, the diagram is telling basically what depreciation is, right? So maybe, because if you didn't really mention depreciation at the top, so maybe the examiner would think maybe the student is explaining appreciation, and according to him the currency appreciates when supply goes up. While this is not true in your head, but he could think of that, and he'll then need to sort of read your paragraph down below to sort of validate that it's not, or to prove himself wrong, right? So putting a heading serves a lot of purposes. Now, guys, our next step in the essay would be that we would basically explain the causes of the depreciation of the currency, because that is exactly what the question is asking us. Now, as far as the causes are concerned, usually I tell my students around 6 to 7 causes in my classes, but for this particular YouTube video, I've written 4 causes. And even out of these 4 causes, since it is an 8-mark question, again I'm repeating, since it is an 8-mark question, even if you write and explain, not only write but explain properly, 3 of them, so we would be good to go, right? So what you could talk about is that since USA is our base currency, you could say that maybe US businesses are investing abroad, and if businesses decide to move outside of the US, this will involve selling the dollars in order to buy the foreign exchange to invest in the country where they are locating. And this will shift the supply curve of the dollar to the right from S1 to S2, causing it to depreciate from P1 to P2, right? And that's one likely cause of a currency depreciation: US businesses investing abroad. The second cause that you can write is increase in domestic incomes in the USA. So if USA incomes are rising, maybe there's a boom at home, then it would involve since real GDP and incomes in the USA would go up, it would involve USA consumers and firms to import more, right? In economic terminology, this is basically known as the sucking in of imports, right? And what happens is that the import expenditure would go up, and this would basically involve selling the dollars in order to buy imports in foreign currency, right? Shifting the supply of the dollars outwards from S1 to S2, causing it to depreciate from P1 to P2, as we have shown in our diagram. The third is the lower investor confidence in the economy. And if investors in the USA feel that the economy is weak, it is fragile, or it is volatile, because that causes instability in the economy and uncertainty, especially. And it's if the economy is weak in terms of its performance and in terms of its returns generating for the financial investors. So investors would basically, investors and businesses would basically sell the dollar in order to gain a more stable and a reliable rate of return elsewhere in the world, and they would move their capital out of the country from USA else to somewhere else in the world, and that would involve the selling of the dollar, shifting the supply of dollars outwards and depreciating the dollar, right? And the fourth one that you could talk about is, which personally I really like this point, a fall in the relative interest rate. It's a good point that you could mention, and it basically involves when if the relative interest rate goes down in the USA, then relative interest rates in the sense that interest rates in the USA in relative comparative terms. So financial investors will move their money out of USA's financial institutions in order to chase better interest rates elsewhere in the world. And this would result in hot money outflows, right? Money would move out of USA's financial institutions and banks, um, you know, and that would basically cause the supply of dollars to go up, causing the US currency to depreciate and weaken, right? So these are the four causes that you can mention. Even if you mention three of them, it's not, again, not mention, explain it like I have explained it, in the video, then you're good to go, right? So this basically answers the part of the question where they are saying that explain the likely causes of a depreciation of a floating exchange. And by the way, if for example, we have taken the stand that the supply is going up, right? Like I said, currency could depreciate also because of a fall in the demand of the currency. And if you say that, let's suppose, even if you don't make the demand diagram for it where you show that the demand is falling, but you just mention, let's say you mention a point that a fall in US exports, fall in USA exports, maybe because these exports become uncompetitive in the USA, maybe because of cost push inflation in USA. And if these exports become uncompetitive, the demand for US exports would go down, and the demand for US exports would go down. It will decrease the demand for dollars. Basically, that would cause the US dollars to depreciate and weaken, right? So this is something that you could mention even if you're not making the demand diagram and you've just made the supply diagram. So still we can live with it. We're still good to go. Now, moving on to the evaluation part of the question, where the question says consider whether such a depreciation is always beneficial to an economy. Now, we know that post 2023, the 8 marker involves an evaluation which the examiner has given it a weightage of 2 marks. So the question says consider whether such a depreciation is always beneficial. Okay, before we move on to this part, one thing that we should in fact also, one thing I forgot to tell you in fact is that once you've explained the causes of depreciation here, you are also supposed to talk about the effect of depreciation that will have on the economy. And the reason we're supposed to talk about the impacts of depreciation on the domestic economy and those consequences or effects could be both positive and negative, is because the later part of the question asks us to consider. It says consider whether such a depreciation is always beneficial to an economy. So later on, when we evaluate and make a judgment and form a conclusion, that judgment or a conclusion will take its shape from the positive and negative impacts that we had mentioned regarding depreciation. Now, guys, the next step would be to show the impacts of currency depreciation. And over here, you can see that both of these impacts that I have mentioned are actually positive impacts. And then, since the question says consider whether such a depreciation is always beneficial to an economy, we could critique the argument of the benefits of currency depreciation on the macroeconomy. And we could say under evaluation, the circumstances when a depreciation to an economy will not be beneficial to macroeconomy and have an adverse effect on the macroeconomic indicators. So what you could say is that a currency depreciation will improve the balance of trade for a currency, because what happens is that a weak exchange rate, when the exchange rate weakens, it makes your exports cheaper and your imports expensive. That is, the price of your exports goes down while the price of your imports go up, right? And economic theory suggests that the demand for imports and therefore the expenditure on imports will decrease, whereas the demand for exports and therefore the revenue generated by the exports will increase. If the elasticity, assuming that the elasticity of demand for exports and imports are greater than 1, or you could also mention the fact that if the Marshall-Lerner condition is met, and both effects will lead to an improvement in the trade balance of the current account and reduce the current account deficit, or maybe move it to a surplus, right? And this is especially true if the country is suffering from a large balance of trade deficit. So obviously the fact that your currency weakens is really gonna reduce your current account deficits, and that is actually one of the reasons why governments might also devalue the currency to improve the current account deficit. Although here it's a floating exchange rate, the government does not intervene and the central bank, in fact, does not intervene, and there's no devaluation. But just I'm telling you this, okay? And the second advantage that you need to mention is that it will result into higher economic growth, and the unemployment will go down, because a weak exchange rate is making your exports cheaper and imports expensive, and as a result, it's causing your import expenditures to go up to import expenditures to go down, while your export revenues to go up, right? Because the demand for imports and therefore the expenditure on imports will decrease, whereas the demand for exports and revenue generated by the exports will increase. And both these effects is causing a balance of trade surplus either, or maybe your deficits to go down. And the thing is that since X minus M, you need to understand that if you're saying that your export revenue is rising and you're saying that your import expenditure is going down, so technically the fact that export revenue is going up is X, right, in the AD equation, and import expenditure is your M in the AD equation. So what's happening is that your net exports are going up, basically. So if net exports are going up, then your AD is going up. So aggregate demand in the economy would go up, and that would cause your real GDP to go up, right? So real GDP and national income goes up from Y1 to Y2. So necessarily, I mean, there's no need to make the diagram here since it's an 8-mark question. Otherwise, if it was a 12-mark question, maybe some showing, you had to show the effects of depreciation, then showing the diagram and making the AD to shift to the right would have been a good choice. Anyways, so the demand is going, the aggregate demand in the economy would go up, but obviously this will have an impact on the labor markets in the economy as well, because the demand for labor will go up, and hence, because the labor demand is derived demand, so employment will go up, and unemployment will go down, especially cyclical demand deficit unemployment, right? Cyclical unemployment goes down and economic growth goes up, right? And obviously when economic growth is going up, so your living standards will go up as well, and your tax revenues will go up as well. But obviously you don't need to go into a lot of detail because it's an 8-mark question. Now guys, the next step would be, after mentioning all the pros for currency depreciation, we'll move on to the cons. And there's one disadvantage of currency depreciation or weakening of the exchange rate is inflation. So these were basically your pros for currency depreciation. And now the cons, which is you have one disadvantage here, that is inflation. And so demand for inflation, as already mentioned, is likely to increase because AD is going up, and that's putting pressure on the existing factors of production, increasing the, and when more pressure is put on the existing factors of production, because aggregate demand goes up, so it creates shortages of factors of production in the labor market, especially labor shortages. And that sort of what that does is that firms then compete for the best workers, and as a result, that drives up the costs for firms, because they're asking their workers to work more hours, in fact work more unsustainably, and they're using all their resources unsustainably, and that causes the firms to end up paying the workers more. But at the same time, although they're paying the workers more and that's driving up the cost, but that they're paying them more because the workers are also producing more output. So understand this, that in demand for inflation, when firms are paying the workers more, they're also producing more output. So that's why demand for inflation seems desirable in the context, assuming that the rate of demand for inflation stays within the desirable limits. So the real GDP is going up as well, right? So that's why. At the same time, so it puts so at the same time, the cost push inflation will increase as well, because now the firms need to pay more for imported raw material and key commodities, because now they have become more expensive as the currency has weakened. And as our US dollar weakened over here, we need to buy, so for example, if we want to buy 10 pounds worth of goods, we need to pay $2 now. And assuming that the PD for imports is inelastic, and it is inelastic for key commodities and imported raw materials such as oil, and that would cause your short-run aggregate supply to shift to the left, causing cost push inflation in the economy. And guys, you see, like I mentioned under demand pull inflation as well, that demand pull inflation, I also mentioned that the cost of production is going up. But you need to understand that the cost of production goes up because when firms would hire more workers, because of a rise in aggregate demand in the economy, they would ask them to work more and longer hours. That will lead to the resources being used unsustainably, that puts pressure on them, and that drives up the cost of production. And then higher cost of production means that firms need to sort of, and that feeds through the economy in the form of higher inflation, higher demand for inflation. While under cost push inflation, it's not that the cost is rising because the workers are producing more output. It's just that the cost exogenously or independently starts rising. It's because of a negative supply shock. Maybe oil prices go up, maybe wages go up, right? So, or maybe, maybe the indirect taxes go up. So that causes a rise in costs for each level of output. So now the same level of output becomes more expensive to produce the same level of output, right? So that's cost push inflation. So I strongly recommend that because O levels as well, and IGCSE students write that demand pull inflation occurs when aggregate demand goes up. While this is not wrong, but for an A level student, this is highly not. I mean, this is not the right. This is not the correct way to explain demand pull inflation. In fact, it is incomplete. So what you're going to say is that demand pull inflation occurs when aggregate demand goes up. That puts pressure on your existing factors of production. That drives up the cost for the firms, and that then feeds through demand pull inflation in the economy. Because when the cost goes up, the firms would need a higher price to cover higher costs, right? While under cost push inflation, the cost of production rises independently, exogenously, due to negative supply shock for the same level of output. But in demand pull inflation, if the cost is going up because the firms are paying more, so they're paying more because they're asking the workers to stay longer and work more hours. That is why they're paying more. At the same time, more output is produced. So this is the basic difference. So it's not just that demand pull inflation is not the only reason. That aggregate demand just is the initiating factor that generates. So you need to understand that if you make the Keynesian diagram, so for example, there's a reason why under Keynesian diagram, let's say if you make this Keynesian diagram, there's a reason why under Keynesian diagram of aggregate demand. So why doesn't demand pull inflation occurs over here? Have you ever thought about it? If this is 81 and this is 82, why isn't demand pull inflation occurring over here? Now you guys have obviously rote learned it that there's no demand pull inflation over here because there's a lot of spare capacity. But then what is the mechanism? The mechanics or the economics behind it is that over here in this range, since there is a lot of spare capacity, there's no pressure on the factors of production. That doesn't really drives up the cost of production for firms. There's so much spare capacity in the labor markets. Workers are totally idle, right? That even if you ask them to produce more output, you don't need to pay them more. So there's no pressure on them to produce more output. So and they end up producing more output at the same wage rates or at the same cost. And so what's happening here is that the firms are producing more output without the firms needing to, pay them more for all the extra output that they're producing, because there's so much spare capacity. And firms really aren't competing with each other for hiring more workers because everyone is just idle, right? And everyone is just jobless, and everyone just needs a job, and they need work, right? So that is the reason, actually. So what's up? Now, all of this you don't need to explain for this question. It's just that since this came up in this question, so I explained it to you. But for this question, just saying that inflation will occur because of rise in AD, but do mention that will put pressure on the existing rates, just like the way I mentioned. There's no need to make the diagram here for an 8-mark question. But at the same time, cost push inflation will occur as well. And because of a cost push inflation, why would cost push inflation occur? Because obviously, the cost of raw materials would go up, and that would cause higher costs in the economy. And this is actually worse. This is really, really bad and worse for nations that depend heavily on imported commodities and raw materials, because it could significantly dampen and reduce economic growth. Because, for example, under cost push inflation, your short-run aggregate supply shifts inwards. Just you could label this short-run aggregate supply over here from SRAS1 to SRAS2. And this is SRAS1, this is SRAS2, and that causes the price level to go up, and that causes real GDP to go down from Y1 to Y2, right? So, and this is SRAS1, and you could label this SRAS2, and that causes real GDP to go down. So this is basically, and the fact that your real GDP is going down, maybe your real GDP could go down to this extent, so much, right? Depending upon how much, or your real GDP could go down as well to a much larger extent, depending upon how big or how large the increase in cost is. And this could cause a recession from the supply side, because recession is negative growth, and under recessions, your economy slows down because of a fall in GDP. And although recessions are more associated and linked with a fall in aggregate demand for 2 consecutive quarters, but recessions could also occur from a supply side if this just becomes permanent, and your real GDP keeps on falling because of a rise in cost. Because ultimately, what's going to happen is that your unemployment will go up, and if your unemployment just keeps on rising, the cost is significantly higher, such that it seeps through the entire economy, and it has a ripple effect on the entire economy, spillover effect on the entire economy. Because you need to understand that industry A's output is raw material for industry B's output. Industry B's output is raw material for industry C's output. And that's how higher cost spills over the entire economy, right? So guys, and this will basically cause stagflation in the economy. Stagflation is a phenomena where your inflation and your unemployment is going up at the same time, right? And especially this depreciation could have worse consequences for poor economies or developing nations, which are already struggling with lower government finances and a lot of corruption. So managing such high inflation, and the fact that which is significantly coming from higher costs of production in the economy, could be a significant challenge for governments, considering that they already suffer from lower government finances, right? And with a very poor tax base as well. So for poor countries, this could pose them into a very difficult situation. You could mention this as well. And see, this is what differentiates a good answer from the best of the best of the best answers, right? Now, guys, the last part of the question says that consider whether such a depreciation is always beneficial to an economy. Now, in this part of the question, the examiner is asking us to evaluate basically the narrative that depreciation is always beneficial, right? So the narrative established in the question is that the depreciation is always beneficial, and we sort of need to evaluate this. Right now, we know that we've mentioned the pros and cons of depreciation. So the evaluation over here would basically involve writing the factors that would determine whether whether a depreciation is beneficial for a country or not. While we so here is so the way you will go about it is that in your final paragraph you will say that while depreciation has both pros and cons, and you can write this down as well, as I say, that while depreciation has both pros and cons, the effect of depreciation, whether it will be beneficial for a country or a nation, would depend upon factors such as, and I've listed a few factors that you need to mention, and probably explain one or two as well. Now here, since the evaluation is just for 2 marks, so I mean a small I mean so here you can provide two of them, right? It's not that you need to provide two of them just because it is for 2 marks. Two has nothing to do with 2 marks here. It's just that it's just a common thought or a rational thought that two would be enough. Okay, so the question is asking us to evaluate whether, like I said, it always results in beneficial outcome. So you will say that depends on the elasticity of demand for exports and imports, right? And then you can elaborate it by saying that if the nation is import dependent and depends, for example, like Pakistan's import expenditure comprises of a lot of expenditure on the import of oil and gas, and hence the demand for raw materials is inelastic. And as a result, if the currency weakens, and that would severely impact our current account deficits, because it would increase the current account deficit. Not only that, because import expenditures would rise. At the same time, since you're importing expensive raw material, it would result in cost push inflationary pressures as well, right? And at the same time, since your PED for assuming that your PED for exports is inelastic as well, so in this case export revenues will fall and your current account deficit will basically worsen, right? And then you can say that, and then another factor that would depend on whether a currency depreciation would be beneficial for a country or not will depend upon, you know, would depend upon the incomes and hence the demand at home and overseas. And what this means is that, what this means is basically, for example, if your exchange rate weakens, and we say that it will, economic theory says that it will rectify a current account deficit. This actually depends on whether it will rectify a current account deficit or not, depends upon the demand and, income and demand overseas, let's say. So let's say if demand overseas in other nations is weak, maybe due to a recession in the economies of major trading economies who we trade with. So if those countries are suffering from a recession, so their demand and incomes are weak. So even if our export prices go down, they will still not import from us, right? Or maybe import a bit more, but insignificantly more. So demand for our exports will be still low despite a fall in export prices via or because of a weak exchange rate. So export revenues may in that case not increase, with hence no current account deficit improvement. So the narrative that the examiner is trying us to evaluate on, that whether a currency depreciation is always beneficial to an economy or not, depends upon whether the income and demand overseas is strong or weak. If it's weak, then it won't be beneficial, right? Furthermore, a weak exchange rate will, like we said, that the fact that a weak exchange rate will rectify a current account deficit and benefit an economy would also depend on income and demand at home as well. Because let's say that because import prices go up in a currency depreciation, and import prices go up, so people import less. But what if the demand at home is very strong? Maybe there's a boom in our country and economy is growing, rapidly growing, and employment levels are high, and in that case the demand for imports will be high, with consumers importing. And economic term for that is the consumers would be sucking in imports, right? Despite a rise in import prices via a weak exchange rate. So, import expenditures, therefore, will not decrease with no current account deficit improvement. So, the narrative that it always is beneficial is not true. It depends on. So, this is what evaluation is, right? And it also depends on the severity of the restrictions of trade that have been imposed by foreign governments and foreign nations. For example, if the foreign governments have strict controls restricting the quantity of domestic exports entering their country, because our exports are imports for them, right? So if they have very strict restrictions for imports, so a foreign exchange rate may do little to increase the overall revenue that is brought in by exports, right? So our export revenues will not go up, right? So, but you see, the World Trade Organization, although this point is not relevant for this question, but the World Trade Organization has been doing a lot of work over the last 2 decades in allowing more open and free trade, right? So trade barriers internationally have decreased. Okay. So that's what evaluation is in here, and then you'll end your answer by just concluding. And so you'll say that and a lot of so half of the conclusion would all already be covered is already covered in evaluation, because you have said that while a currency depreciation has both pros and cons, for the final impact on the economy depends on. So this is part of your your conclusion. So after mentioning these points, you'll say in the end that hence policymakers must be aware of these factors, so that appropriate intervention can be made to sort of mitigate the risks involved and improve the macroeconomic indicators, right? So that's it, guys. I'll be ending the video here. I'll see you all around in the next video with another past paper question. If you like this video, do comment, and all the best.